What a time to be in the stock market, folks. A lot to get into in today's video. I want to talk about many different things in the market. I want to talk about some stocks today. I want to drop a few gems out there for investors out there looking at this market, trying to figure out opportunities, trying to figure out how to look at a market like this. I definitely want to drop a few gems for you guys because I've definitely been in these sorts of markets before. And I will say this is arguably the most hated bull market I've ever been in. But I have been in some of these sorts of markets where you have some very exciting things going on. And everybody's trying to figure out, is this a hype cycle? Is this real? Like, do we have a long way to go here? And those sorts of things. So I hope you guys enjoyed today's video. As always, I appreciate everybody being subscribed, spending some time with me here today, folks. Okay. And as somebody who's been in this market for about 15 years now, I got to say, today was surprising to me. Going into today, it felt like the type of day where we could have a pullback. A pullback meaning, S&P 500 down maybe 2%, 2.5%, something like that type day today, right? Maybe everybody kind of worries a little bit about the Fed. Oh, is the Fed serious about raising rates more? Like, what's going on here, right? And it felt like it should have been one of those sorts of days here today. And it was just not. It was just not. It was actually a great day. You should have been up very nicely in your portfolios here today. Dow was up 400 plus points. NASDAQ was up here today. S&P 500 up here today. Very surprising. And look what just happened here today. Look at this baby. Meta just crossed over $500,000. I've been tracking this like a hawk in terms of public count and waiting for this one to crack over $500,000. It just did it here today. This stock continues to have momentum. Now, the shocking thing in regards to Meta, okay? And this is shocking because everybody sees a stock like this and it just goes up. Seems like literally every day. Almost every day you wake up and the stock's up another 3%, 3%. The most shocking thing about Meta is what I'm about to show you here. And that is Meta, even after this insane epic move it has had, where it seems like every flip and flapjacking day it's up 3, 4, 5%, the stock is still a steal deal right now. It is still a steal deal. It's trading at, based upon the numbers analysts have for 2024, it's trading about 19 times next year's numbers. Now, keep in mind, I think next year's numbers in terms of analysts have gone way too conservative. I don't think they've fully priced in the amount of job cuts, obviously, Meta's done, and as well as a lot of the new business lines. So I believe that this is a very conservative number. I think $15 to $18 is pretty realistic in my personal opinion for next year. So this number is actually lower. But even if you were to say this number, this stock's still trading way undervalued. This is trading kind of in line with where the market's at. You think Meta's going to only grow with the market? Come on, man. This stock's going to completely, kind of decimate the market in terms of its growth rates versus the market over the next several years. So, that's the thing about this market. It doesn't matter like if you see a stock up 1,000,000%, 100%, 50%, it all matters about where the valuation's going over the coming 5, 10 years based upon where the profitability of the company is going to go, okay? And based upon what the company's market cap's trading at today. Look at a stock like Palantir, right? Stock like Palantir, now we're up 89% on the stock. It continues to perform. This is kind of like a Meta stock, right? In terms of it just seems like every day you wake up, it's up another 2, 3, 4, 5, 6%, whatever, right? It's doing tremendous, but I had a very tough decision recently in regards to Palantir, and this is just kind of the first of, well, actually, I think the first gem was just kind of pointing out, like, a stock like Meta is still a steal deal. But the second gem I want to give to you guys out there in regards to this is you can't be too afraid to buy a stock when you're up on a stock. Okay, this is something that somebody like myself has always struggled with, and I know a lot of investors struggle with this. Okay, and in regards to Palantir, right? I've been buying the stock for quite some time, right? All the way back to last summer, I was buying the stock. And it's very easy for me to buy Palantir stock when it's under $10 a share, right? Just buying shares left and right. But what about when it went over $10 a share? And I had a very tough decision I made recently. And I bought another 645 shares of Palantir stock at $15.45. Now, that's a massive difference between what I was paying for Palantir versus what I paid for Palantir in this recent buy back on June 6th, right? But at the end of the day, I thought about it and I said, do I believe Palantir is still undervalued from where I think this company is going over the future years? And my conclusion was, based upon the numbers I think they're going to hit, and based upon the current market cap, yes, it is undervalued, and I'm still going to make a lot of money on these shares that I bought at $15. And so I went ahead and I made that move, and I bought a bunch more shares, even though it makes my cost basis look far worse, right? Because at the end of the day, look at all the other shares I bought at Palantir. Obviously, they're at way lower prices than what I bought these most recent shares. And so the thing you've got to remember when it comes to this, and it goes back to kind of the Meta example, is at the end of the day, if you are getting a great deal on a stock, it doesn't matter what you bought it at in the past. The fact that I paid $7.49, $7.35 for Palantir shares is irrelevant. All that matters is those new shares I bought, am I going to make money on those over the next few years? And I believe I am. And so I've got to take that opportunity, right? And so you look at a stock like Meta. Meta's a stock I bought a million times over the years. Like the amount of Meta shares I bought over time is ridiculous. And over a very long period of time. And so I could have just worried about Meta in regards to like the percentage gain, which I could have played that game, but at the end of the day, I care a little bit more about the dollar amount gain when it comes to stock like Meta. And by the way, I'd be buying more Meta right now. What's the only reason that's keeping me from buying more Meta shares right now? The only reason I'm not buying more Meta shares right now, even though it's still stealing money, is because it is such a large position in the portfolio. It's $512,000 position in the public account. Public account's a $1.7 million portfolio. So there's a lot of other opportunities in the market outside of just Meta, and so I'm placing money in those at the moment. Doesn't mean I'm selling Meta or plan to sell Meta anytime soon. Meta would have to be like $400+ for me to even start to consider selling the stock. So we're a long way from that game. And that's even considering, I don't even know if I would sell if stock was 400 today, which goes to show you kind of my belief in the stock and where I think it's going over the next few years, okay? Now, in regards to Tesla, this was a really hard one for me to decide, right? And sometimes you got to ask yourself, what is more important to you, your ego or money? And many times our egos can get in the way of money. I can tell you it's gotten in my way plenty of times over the years where I care more about my ego than I care about money. And sometimes you just got to say, the hell with my ego, I'm going to worry about the money. And a good example of this is Tesla stock. Obviously, back in the day when I was buying my Tesla shares, I got them at disgustingly low prices, right? I saw a great opportunity in the market. I thought what I thought about the company. I would talk about it all the time. And darn it, what I thought was going to happen, happened. And the gains on the stocks is ridiculous. 1,600% gain, 1,900% gain, 1,800% gain, right? But at the end of the day, I even bought shares recently. I bought shares back in December. I bought shares in January, 145 shares there, 20 shares there. This makes my cost basis look far worse because I bought new shares. But at the end of the day, I said, the stock's undervalued now at this point in time, and I need to add shares of Tesla stock because it's a deal. It's a deal. And so, yeah, it made my cost basis look not as exciting. Now I'm only up 984% instead of being up 1,000 something percent like I would be if I never bought those Tesla shares. But guess what? My dollar amount's a lot bigger because now on those shares, I'm already up $21,000 on those shares I bought back in January. And I'm already up $2,600 on just those 20 shares I bought back in December, right? So that's something very, very important. And we look at a stock like Amazon. This stock, I don't, at the end of the day, Amazon, anything under $150 a share is me buying. When Amazon goes over 150, it will just be a hold for me at that time. So at the end of the day, I'm looking at Amazon and I've been buying the stock and buying the stock and buying the stock and buying the stock non-stop, right? Week in, week out, pretty much almost like clockwork, just buying Amazon shares. Sometimes when it goes, really low, I would buy extra shares, right? Like this one's an extraordinarily big buy, about 235 shares here when the stock was at $92.80. So sometimes I'm going to pick up a bigger amount of shares, but I've just been picking up shares of Amazon over and over again, including 200 shares here at 126. At the end of the day, when it comes to Amazon, any shares I can get that's less than $150 is, in my opinion, a great buy, a great buying opportunity. I've got to take advantage of that. And so when you're in the market, you have to decide, do you care more about this number or do you care more about this number? Because I could buy just a few shares of a stock and it goes up 1,000% and the percent looks amazing, right? But because I was so worried about the percentage gain, I forgot about, what really matters in the end, the dollar amount. Knowing at the end of the day, percentage gain is cool, but it's really cool when you got a big dollar amount behind it, right? And so that's just some food for thought out there that I think is very important. And coming from somebody like myself that has always had trouble buying a stock when I'm up on a stock, it's been always a very difficult decision, but it's a decision that has to be made, right? You look at a stock like ELF. Huge mistake I made with ELF. Here's the thing with ELF. As I bought that stock, which I started accumulating shares of ELF, it was probably, if I recall, it was very early 2019, either late 2018 or very early 2019. Started accumulating shares of stock. And between my different accounts, at the peak, I owned probably close to 10,000 shares of ELF, right? Here's the thing. Fundamentals kept getting better and better for ELF as time goes along. And what did I do? Instead of buying more shares, I went ahead and started selling shares. But the fundamentals were getting better. So in reality, what I should have been doing with ELF, minimum I should have been holding, because the fundamentals was getting better and better, revenue, margins, profitability, cash flow, everything was getting better and better. At the least, I should have held every share I had. Or what I really should have been doing, I should have been buying more shares instead of worrying about selling. When the fundamentals are getting better and better and better, it makes sense to buy more shares, or at least just hold, but don't sell. Okay? If the fundamentals are getting worse and worse, that's a fair play. I could sell out of the stock, right? I'm like, oh, revenues are starting to go down. Oh, margins are starting to go down. Business is deteriorating. Okay. But when things are just getting better and better and better, it doesn't make sense to sell out of the majority of your shares, right? And a good example of a stock went bad where the fundamentals kept getting worse and I kept buying it just because it got cheaper was obviously the Chef, right? And that's a huge, huge mistake I made there. Huge financial mistake, right? Because that business just kept getting worse and I just kept buying shares. If the business kept getting better, fair play, and the stock's cheaper, you can buy more shares. But when it just keeps getting worse, no. It doesn't matter if the stock's down a bunch. It doesn't matter how attractive the pricing is. If the fundamentals are just getting worse, you got to cut that baby. You got to cut that baby and say, so long, okay? You give it a few quarters. If after a few quarters it's not working out, and the fundamentals are just getting worse, there's a big difference between the fundamentals of a business and a stock price of a business, okay? That's the important thing to remember. Now, you look at a stock like PayPal. This is a stock I'm starting to accumulate pretty heavy, pretty fast here. And I love this one. Why do I love this one so much? And why do I plan on making this a big position for me, meaning a six-figure plus position in terms of PayPal? The reason being is with PayPal, the stock is extremely cheap. Okay, I mean, extremely cheap, profitable company. Trading at a forward P of this year of like 12, like that's a laughable joke. But not just that, the fundamentals of the business are getting better and better and better. You look at where this company's gone over the last number of years, and look at the 5-year CAGR for PayPal overall. It's absolutely amazing on pretty much every single metric you could possibly want to be amazing, whether it's active accounts or total payment volume, net revenues, free cash flow, non-GAAP EPS. It doesn't matter what you look at. It's gone phenomenal. But not just that, the fundamentals are getting even better right now. Non-GAAP EPS growth for this year is expected to be 20%, right? Non-GAAP operating margin expansion of about 100 basis points they're expecting. Free cash flow of $5 billion. Net revenue growth expected this upcoming quarter, 7.5% to 8%. Don't be surprised if they beat that, by the way. Non-GAAP EPS growth expected 24 to 26%. I love it if a company of mine can grow their EPS at a much faster rate than they can grow their revenues, right? So I'm looking at that, and we got a business here that's trading extremely cheap, where the fundamentals are getting better and better and better. And so that means buy. And so what I'm doing is I'm buying shares left and right now of a stock like PayPal because it's the perfect scenario. If the fundamentals of PayPal were getting far worse and they're expecting EPS to go down 20%, although the stock's cheap right now, it wouldn't make sense. It's too scary. The fundamentals are getting worse in that situation. But when the fundamentals are getting better and you're getting cheap, now we're talking, right? Now we're talking in a major way. Now, next gem I want to drop out there is you're looking at all this excitement around AI right now. There's a lot of excitement around this, right? Microsoft stock hits record today after executives predict $10 billion in annual AI revenue. Microsoft shares climbed 3.2% to a record and now at 46% this year. The company could pick up $10 billion or more in annual artificial intelligence revenue from developers using Azure Cloud and OpenAI models, an executive said this week, right? Now, first thing is, AWS is going to end up benefiting in a massive way from all this AI stuff as well. So do keep that in mind, okay? Don't think Microsoft's the only way to play that whole game. AWS will benefit in a massive way. But this cycle you're seeing in AI, this is not the first time we've seen this with these big, huge companies, okay? I remember I got in the market 2008, 2009. And I was just trying to learn everything. And then, I'd watch a lot of CNBC, especially like 2010, 2011, just trying to pick up on terminology. Because when you're getting started in the stock market, like usually it takes you several years to really get your feet under yourself, right? And so I'm just trying to pick up all this new terminology and just watching a lot of CNBC and just, embracing what the stock market is. I really loved it, and I just started embracing it in a huge way, right? And I can tell you something I heard talked about countlessly was this thing called the cloud. And oh my gosh, it seemed like every flippin' flapjacking day, they would talk about the cloud. And this was specifically kind of like 2010, 2011. And, I didn't really get it that much at the time. I didn't really realize how big it would be, right? And you could easily say at that time period, like, oh man, maybe this is just a big, huge bubble or something like that. You could say that because everybody was talking about this cloud, and a lot of people didn't really understand it. They didn't understand how big it was going to be, how big the opportunity was going to be, right? And it came in at kind of a perfect time in terms of everybody starting to talk about it, because the stock market bottoms Q1 of 2009, right? After that massive epic crash we had, the great financial crisis. And then we started recovering the market in a pretty fast amount of time. I mean, from NASDAQ down to, around 1,300, 1,200 range. To the next thing you know, by the time we were getting ready to go into 2010, it nearly doubled. Think about that for a moment. From where the market bottomed in Q1 09 to where the market exited 2009 in Q4, the market had pretty much doubled in terms of the NASDAQ. Now that's a move. That's a move, folks. In 3 quarters, nearly a double up for the NASDAQ. That's a flippin' flapjacking move, okay? But then the market went nowhere for a bit, okay? Starting as soon as basically we entered 2010, all the way through into about the second half of the year, the market was kind of no man's land. And then a lot of talk and excitement started to happen around 2 segments. One was the cloud, the other was mobile, okay? There was 2 big things happening at the same time. Cloud and mobile, and a lot of people were getting very excited about this. Cloud, meaning businesses moving onto platforms like AWS and others, right? And that whole move to the cloud and how many businesses are going to thrive off that. And some businesses just built these incredible, gigantic corporations just basically off of the cloud. And mobile, obviously, because Apple, now the iPhone was starting to take off, right? iPhone got shown off in 2007, started to ramp a little bit in 2008, 2009, and then obviously in much more substantial way in 2010, as well as iPad got shown off, if I recall, in 2010. So mobile, everybody started talking about it, right? And you had these 2 things, and that brought up the market in a huge, huge way. And also earnings were behind it as well, right? And so it was a very important thing at a very important time. And this was during a time period when a lot of people were talking about double dip recession. It's going to get worse. Remember, there was very few people that felt like we were going to be okay in Q1 of 2009. When the market bottomed, most people said, we're going lower, we're going lower, we're going lower. This isn't the bottom. You haven't even seen the bottom yet. It's going to get way worse, okay? And I understand probably a lot of people that are watching this video, you weren't around back then. You weren't investing in that market. But I can just tell you, there was no consensus, like everybody feeling like, oh, we're good now. Everything's going to be fine now. No, people were uneasy. A lot of investors didn't want to buy that market. As that market started to go up in 2009, it was a very hated market because there was a lot of bears caught on the wrong side, saying, look at how bad the economy is. Look at unemployment. Look at the company numbers. And you guys are out here buying the stock market, doubling up the NASDAQ in a matter of months? What are you guys thinking? That's what they were all saying. You guys are delusional. Bunch of hype monsters. We're going to crash back down worse than ever. You have no clue what's coming. And that was a talk, right? And so, some people started to believe that in 2010. And then we had the massive cycle. Now, if you look at somebody like Amazon, right? In 2010, 2011, this company wasn't even doing $1 billion of annual recurring revenues from AWS. That's how small AWS was back in that time frame, right? But there was a lot of talk that, hey, this AWS thing and these cloud companies are going to benefit in a huge, huge way. But very few understood it and saw it at that particular time, right? And look where AWS ended the decade. They ended the decade at, from basically, 2010, 2011, less than $1 billion of annual recurring revenues to 2020, 45 flipping flapjacking $1 billion in annual recurring revenues from AWS. That is unbelievable, right? Unbelievable. And a lot of people thought this cloud thing wasn't going to be all that. And then it turned out it was all that and a whole lot more, right? And you look at a stock like Amazon, right? That stock performed amazing over that decade, essentially, right? easily a 10x type stock over that decade. And it didn't all come at one time. It just came over time. And as AWS got bigger and bigger, more people started to look at it and start to respect AWS and started to respect Amazon from a standpoint of this isn't just an e-commerce company. This is not just some company building warehouses and more people are ordering stuff on it. It's got this incredible business, AWS, that could actually turn into a cash flow machine for the company. And as the company got more and more respect for that over time, the stock went up more and more and more. And as more people understood the cloud and the opportunity for AWS, obviously more and more folks bought into AWS, bought into Amazon and understood this sort of opportunity here, okay? Now you look at a stock like NVIDIA. This stock's red hot. It's up nearly 200% in the past 6 months or so, less than 6 months, right? And everybody's looking at this stock. A lot of people have been short selling NVIDIA, losing their face on this stock. It's such an obsession around trying to call the top on NVIDIA. It's ridiculous. I mean, it's an epidemic. It's an epidemic, folks. The amount of people I've just heard from either friends, acquaintances, people online that have been short in this stock, put options. I can tell you, if we could put everybody on a lie detector test and say, have you lost money trying to bet against NVIDIA? The amount of people that would have to raise their hand or would fail that lie detector test would be a epic, massive number. I can tell you that. Because people have been calling this needs to go down since it was 150. Then it went 200, 300, 400. And people have just been losing their everything on this stock, trying to bet against it time and time and time again. But the thing you got to understand about a stock like NVIDIA, right? One is these chip companies usually go on a 2 to 3 year cycle for a big new chip cycle. So these AI chips, you could easily see massive explosion in revenues and profitability for this company for the next 2 to 3 years. So a lot of people are banking that this is only going to be a 1 quarter thing, when in reality, these major chip cycles for a company like NVIDIA, AMD, they last several years, folks, okay? And the way I would think about this is a stock like NVIDIA is the foundation. They're a foundation company. They make the money before everybody else makes the money, okay? Because in order to do a lot of what all these other companies are going to benefit from and be able to do, right, and make a lot of revenue from, you first need the chips to make it happen. So NVIDIA is the foundation layer, folks. They're the foundation layer. And I call them the foundation layer because it's no different than, let's say, I don't know how many people are familiar with building a house, like from the ground up, right? Here's the thing. Let's say you go to KB Homes or Toll Brothers or Lennar or whatever, right? You might think, oh, that's all their employees building the houses, right? No, it's a bunch of different companies, a bunch of different independent contractor companies that they pay to do a job and then another job and another job and another job, okay, until the home's all the way finished. And so there's like a million different people and a million different companies that make money off that, okay? These aren't all Lennar employees because that would be way too much overhead to have to worry about having your own employees that are the painters and your own employees that are doing the foundation. It's too much. So they have independent contractor companies do all that, okay? And they basically outsource, they get bids for all this, okay? So NVIDIA is a company that's doing this foundation work. So while they're making all this money, right, because they're going to be paid first, all the other guys are still waiting to make their money, right, because they're waiting to do their job. So this is why I call NVIDIA the foundation company. And all these other companies, you're going to see them make money over time. Microsoft, Meta, Amazon, Palantir, Tesla, all these companies are going to play huge in AI, right? And they're all going to benefit in a massive way over the next many years. It's not just going to be over a quarter or two, it's going to be over many years. And so as the house gets built, they're all going to start making major money. They don't really have it coming in like that right now, but wait to see in a quarter from now, 2 quarters from now, a year from now, wait to see the money start to roll in for those guys as they get up for their job now. And they put their roof on, right? That's when they start to make the money. So a lot of people are getting so caught up into NVIDIA and everything here, and it's just like they're the foundation layers. They're going to make the big money here in the short term, and then a lot of people will own a lot of the chips they need, and then there'll be some sort of lull for NVIDIA for a bit, where the stock will probably go down 40, 50%, but there's no telling when that could be. That could be a year from now. That could be 2 years from now, 3 years from now. There's no telling, right? And then NVIDIA will come out with some new major chip and some new excitement, and then they'll have their next big growth lever. That's the way a company like NVIDIA does it, okay? And so these companies, you'll see the major financial benefits from them over the next several years, okay? Now, With all this in the market, keep in mind, protection is important. And so check out this video I put out 5 days ago. If you didn't watch this video, make sure you watch this video. Investors Just Went Bullish, do this now. That video there runs through a bunch of different hedging strategies that are very helpful. Because I can tell you, a lot of you guys probably aren't hedged at all in the market. You're, just all long, and there's nothing wrong with that, but I'm just telling you, you need some protection out there, just in case things go bad. It's great to have a little protection. It's great to have some hedges on. It allows you to invest more freely. I can invest very freely because I know if the market tanks, I got plenty of hedges on the market that are going to print money. And if the market goes up, great, because the amount of money I'm going to make off that is way more than whatever the value of the hedges will lose. And so definitely check out that video, guys. A lot of value in that one. I appreciate you guys, as always, being here. I hope you got a lot of value out of today's video. Thanks for being subscribed, folks. If you're looking to take your investing game up to the next level, apply for my private group. That's going to be linked in the description area down there. Also in the description area down there is a free workshop I put together. I put one together for you guys that make less than $100,000 a year and one for you that make over $100,000 a year. It's a free workshop. You can get access to that, investing tips in this year and beyond. So appreciate you guys. Much love as always, and have a great day.